I'm so excited that you're looking at using your VA loan. It's an awesome benefit and probably the best home loan program out there. Now, whether you've never used a VA loan before or you've used it 5 times, I still like to go over some basics just to make sure we're on the same page from A to Z with how some of the details work. There are a lot of common misconceptions about the VA loan, so I want to make sure we cover those. One is that you don't need any money to buy a house. Yes, the VA loan is fully financed, no money down, which is incredible. That being said, you do need to have some money available. First, for earnest money. When you make an offer on a house and you go under contract, within a few days of going under contract, you have to provide earnest money. Earnest money is essentially a deposit that you put down showing the seller, hey, I'm serious about buying this house. I'm putting some skin in the game in the form of earnest money. The amount of the earnest money is negotiable, but the standard is generally 1% of the sales price. Now, the seller will always be asking for a specific earnest money amount. However, when you write your offer with your agent, you can set that earnest money to whatever you want it to be. Normally, we see the minimum being about $1,000. So you want to make sure you have at least $1,000 saved and set aside, ready to use as earnest money. Because a few days after your offer gets accepted, you're going to have to write a check for that earnest money, and that money is going to come out of your bank account. Now, for the lending process, the earnest money is going to be sourced. That means we're going to track or trace where the earnest money came from. So we've got to make sure it's coming from a valid source. A valid source just means that it's already been sitting in the bank for at least 60 days, or that it's being deposited from payroll or some other valid source that we can track. The important part here is you can't go get a loan for the earnest money. You can't take a cash advance on a credit card. You can't use cash under your mattress. None of those are valid sources. So make sure that if you don't have the money sitting in the bank already, or it won't be deposited there from payroll, we talk about that specific scenario just to make sure it'll be okay with the underwriter. Now, many people think that this earnest money is like a security deposit and that you just get it back at closing. That's a common misconception. It is actually a deposit on the transaction. For a VA loan with no down payment, yes, it's possible to get some or all of your earnest money back at the closing table, but that depends on who is paying for the closing costs and the prepaid items. Another big perk of the VA loan is the fact that you don't have to carry mortgage insurance. So regular loans, when you're putting down less than 20%, you've got to carry mortgage insurance, essentially insurance on the loan in case you were to default. All loans, VA loans included, require homeowners insurance. That's insurance on the home in case something were to happen to it. But here we're talking about mortgage insurance on the mortgage or the loan. So mortgage insurance can be really expensive, but with the VA loan, you don't have to carry it. And that's because the VA guarantees 25% of your loan for you. They're essentially acting like a mortgage insurance provider on the back end. Now, in order to do that, the VA does charge what's called the VA funding fee. The VA funding fee is standard and set by the VA. It's the same for every lender. However, the VA funding fee can still change, and it will vary depending on whether or not you've used a VA loan before and whether or not you're putting a down payment. You're also exempt from the funding fee if you have at least a 10% disability rating or have received a Purple Heart. Now, if it's your first time using the VA loan and you're not putting any money down, the funding fee is 2.15%. However, this is one item that can be financed into the loan. So for easy math's sake, let's say you're buying a $100,000 house. Your base loan amount is $100,000 because the loan is fully financed with no down payment. But then you've got that 2.15% VA funding fee that gets financed in. So your total loan amount is $102,150. So the disadvantage is your loan amount ends up being slightly higher than the price of the house when you close. The advantage is this has really minimal impact on your monthly payment, especially compared to mortgage insurance. On a $300,000 house, that funding fee would be just under $7,000. That's only going to add about $50 to $60 a month to your monthly payment. So it really doesn't make a huge impact. Mortgage insurance in that same price range would average $250 to $300 a month. So although your loan amount is still a little bit higher, your payment is much lower than any other program. Now let's talk about the closing costs and the prepaid items. I think this is one of the most important parts because it's also one of the most commonly misunderstood parts of the process. I've done VA loans for veterans in the past who've had 3, 4, 5 VA loans that don't understand how it works. It's not that it's that complicated, it's just never been properly explained to them. Closing costs and prepaid items are paid one of three ways, normally a combination of three. One is you pay them out of pocket. Two is we ask the seller to pay for a portion of them or all of them. This is really situational dependent. In a perfect world, of course, we want the seller to pay all the closing costs. That's not always realistic. Your agent will be the expert on when we can or cannot try to get money from the seller to help pay for these things. So we'll defer to their judgment. The third way closing costs and prepaids can get paid is by the lender with what's called lender credit. What lender credit is you always hear people talking about buying down the interest rate or paying money for a lower rate. It actually works in reverse as well. You can get paid to take a higher rate. You get paid in the form of lender credit. Then you can use that lender credit to go towards closing costs and prepaid items. Okay. So the important distinction here is if you want us to help cover those closing costs and prepaids, we have to build it into the interest rate, not the loan amount. I often hear people say, let's just roll it into the loan. But that's only possible on a refinance. When you're buying a home, we have to build it into the interest rate instead. So by using lender credit, you take a higher interest rate, which increases your monthly payment, but that lender credit decreases your bottom line, or the money needed at closing. On the flip side, if you want a lower monthly payment, it's going to increase your bottom line by going lower on the interest rate. I wish there was a way to have the lowest payment and lowest bottom line. It's just not possible. There's always a trade-off of one for the other. For VA loans where there's not a down payment, it may be possible to get a portion or all of your earnest money back at closing, depending on how the closing costs and prepaid items get paid. The easiest way to explain this is to run through a few quick examples. So let's say the total closing costs are $4,000. The earnest money that you paid a few days after going under contract was $2,000. For this example, let's say we get the seller to pay for $3,000 of the closing costs. And let's say that you, the buyer, chose the lowest interest rate option without any lender credit. Come closing day, closing costs are $4,000, the seller pays $3,000 of them. That still leaves $1,000 that need to be paid. Since you're not getting any lender credit, the only other way that these get paid is by you out of pocket. Any money needed from you is first and foremost going to be taken out of the earnest money. So we take $1,000 from that $2,000 you deposited up front that's been held, and we use that to pay the remaining closing costs. The other $1,000 that you provided isn't needed for anything. The loan's fully financed, the closing costs have now been paid. So in that scenario, you would get back that $1,000 at closing. If in that same example, the seller was paying all $4,000 in closing costs, none of your earnest money would be needed, so you'd get back the entire $2,000 on closing day. Now, if the seller isn't paying any of the closing costs and we're still at the lower rate option with no lender credit, then your entire $2,000 of earnest money would have to be applied towards these costs, and you'd have to bring an additional $2,000 on closing day to cover the remaining closing costs and prepaid items. I hope that clears up when you would get some, all, or none of your earnest money back, because it all depends on who's paying the closing costs. For some lenders and some scenarios, there can be an intermediate step here, where you pay some of your fees up front, like the appraisal or credit report when you first go under contract. Depending on your loan scenario, you could have an appraisal fee or an application fee. If any fees are associated with your loan, we'll send you a link to pay those and we'll talk about them. But most of the time with us, that's not required. Now, if you do that, that money essentially acts as additional earnest money, where anything that you pay up front is also applied towards the bottom line. So if we go back to the last example, where you're paying everything out of pocket, you've already paid $2,000 in earnest money, and now you also pay $750 for your appraisal about a week into the process. Well, now you've actually paid $2,750 already. So on closing day, you'd only need $1,250 instead of the $2,000 we looked at before. Well, that's a lot of the misconception and education stuff I wanted to talk about. Now let's talk about qualification and how we determine how much you can buy or how much you qualify for. The biggest factors that we look at when determining what you qualify for are your credit score and your debt to income ratio. Credit score is pretty self-explanatory. Let's talk a little bit about debt to income ratio. Your debt to income ratio is the ratio of your monthly debts compared to your monthly income. When looking at that, we look at all the things that show up on your credit report. And then we're just looking at the monthly payments. So for credit cards, whatever your minimum monthly payment is. For car loans, whatever your minimum payment is. I know sometimes you pay more than that, but really we only care about the minimum required payment. Now, debt to income ratio is the biggest factor when we're looking at what you qualify for. So please, if you've added any new debt in the last 3 or 4 months that may not be in your credit report yet, let us know. It will show up during the underwriting process. So we'd much rather know now so we can address it and make any changes if necessary. When we're looking at your debt to income ratio, we're looking at all those monthly payments on the debts that you currently have, as well as the proposed housing payment for the house that you want to buy. Now, that total payment on the home loan that we're looking at is a little different than loans you've had in the past. It's principal and interest of the loan, just like any other loan, but it also normally includes taxes and insurance on the property. So even though the tax bill and the insurance bill are only due once a year, you pay 1/12 of those amounts as part of your payment each month. Then when they're due, the bank just pays them on your behalf. So if your property taxes were $1,200 a year, you pay $100 a month as part of your payment. After 12 months, the lender saved up $1,200 on your behalf. They pay that bill for you. They're really just acting like a savings account for you. I know a lot of you are really responsible and would have no problem saving that money to pay those bills yourselves, but it does make life a lot easier. Something that's commonly misunderstood when looking at that total payment is the portion that's fixed. When we're looking at a fixed loan, that means the principal and interest amounts are fixed. The combination of those will never change. However, your property taxes and your homeowner's insurance, those portions of the payment can change. They don't usually change very fast or very often, but it is possible. If those things change, the portion of your payment has to adjust accordingly. So if your property taxes increase one year from $1,200 a year to $1,800 a year, we're now going to have to collect $150 a month instead of $100 to still be able to pay the tax bill. So if you get a notice about your payment changing because of taxes or insurance, that's why. You are still in a fixed rate loan. Your principal and interest are not changing. However, as those taxes and insurance increase over time, those portions of your payment have to increase with them so we can keep paying those things on your behalf. Now, when we're determining the max that you qualify for, the max purchase price is always going to be a bit of a range, a little bit of an estimate. And that's because those taxes and insurance play a role. Two houses that are the same price can and normally will have different payment amounts because of the different taxes and the different insurance. The principal and interest would be the same. The taxes and insurance are going to be different. And because your qualification is based on the debt to income ratio that's looking at that total payment, you may qualify for one house at $360,000 and not qualify for another one at $350,000. If that lower house price has really high taxes or maybe a high monthly HOA due, then that house may have a higher payment. I know that seems funny, but it all boils down to that total payment amount and how it factors into your debt to income ratio. So just because you can qualify for a certain amount on one house doesn't mean that is the house you should be buying, or you can qualify for that price for a different house. We always like to work backward from your budget. So make sure to talk to us about what's going to work for you when it comes to a monthly payment. Now, if this is your first time buying, you can think about this payment as replacing your rent and your renter's insurance. You're still going to have trash, utilities, and all those other things. This payment will replace the rent and the renter's insurance. Make sure to talk about that payment that's going to work for your budget so you can comfortably afford it and you're not putting yourself in a bad position. Then we can work backwards to see what price range we'll have to get you to that payment. One common question I get is what happens when the appraisal comes into those? Everything in lending gets based off the lower of contract price or appraised value. So when appraisal comes in low, we can only fully finance up to that lower appraised value amount. So let's look at a quick example. Let's say you go under contract to buy a house at $100,000. But when the appraisal comes back, it comes in low at only $90,000. Now the VA will only approve the loan to be fully financed to $90,000. If we can't get the seller to drop the price, you'd have to bring that $10,000 out of your pocket. So you'd bring $10,000 down payment and the VA would fully finance that $90,000, which is the appraised value. Now with a VA loan, we have what's called the VA escape clause. Essentially what this says is that if your appraisal does come in low, no matter when it happens, you can back out of the deal and get your earnest money back. Other loan types have appraisal deadlines where you have to object before that date to get your earnest money back based on the low appraisal. VA does not have that because they have the VA escape clause that covers any time the appraisal comes in low. Even if that appraisal comes in the day before closing, you can back out and get your earnest money back. So let's talk about next steps. First is financial documents. After you apply, you'll receive an email from one of my licensed sales assistants about how to provide the financial documents that we need and what we are going to need for your specific scenario. Jump on this stuff as soon as you can, because once you go under contract to buy a house, there's a lot happening. You're moving, you've got to do an inspection, you've got to get packed. So any stress that we can alleviate from that time, we want to do. And the best way to do that with us is by getting those financial documents in line before you go under contract. It'll be a lot less to worry about on the loan side once things get moving. Then you can focus on finding a house, going under contract, and getting moved. Now, your realtor is going to be setting you up on a home search to start seeing what houses are available in your area. If you see a house you like and you're curious what the payment would be, send me or my team the address and the price. I know there's plenty of online tools to run payments yourself, but I just don't trust them. There's too much margin for error, and rates can constantly be changing. I'm always available, so you can send me a house or a price anytime, as well as my team. We're happy to run payment numbers for you to see what it looks like. If that payment seems doable and you like the house, go check it out. If you really like it and then you think it's the one and want to make an offer, let me know. At that point, we're going to work up a full loan summary from A to Z. That'll show the total closing costs, the total prepaid items, and what other different loan options we have. This is where we can explore lender credit options, buying the rate lower, whatever's going to work best to see if this house can fit your budget. We always want to structure the loan based on your priorities with your house, the projected timeline, and anything else that may be important. I'm amazed how many loan officers just hand out a pre-qualification letter and say, let me know when you're under contract. We never want to do that. This is a huge purchase and a big deal. So we want to make sure we review and explore options with you before you submit that offer so that we know we have a scenario that works. That way, when the offer gets accepted, we can celebrate and be excited and not be stressing about what that loan's going to look like. You'll already know before the offer goes in. We are available 24/7. I've got team members on call each and every weekend, and one of us is available at nights to make sure we're always here to run scenarios so you have the information you need. We never want you to miss out on a house because you're waiting info from us. So feel free to reach out anytime. Now, if it's not an urgent request, we may not get back to you until the morning. I do have a life, I do have a family, so sometimes we're doing something. But that being said, it's never inappropriate to send a text and reach out, and we will get back to you as quick as we possibly can. And if it is time sensitive, we will always jump on it and take care of it right away. I am so excited that you're going to use your VA loan. Can't wait to be there with you and support you through it. Please reach out with questions. I can't wait to connect and talk more and get you out there searching for a home.